Hey, good morning, guys. Welcome to Market Mondays. I'm gonna give you guys a quick update on everything that happened last week and what's expected forward going into this week. Before I get right into it, I'm gonna do a quick dad joke. Dad joke today is my friend of mine, Brandy, has sent me this one. I thought it was a good one. What do you call a toxic work environment? A toxic work environment. A staph infection. Staph infection. Get it? Pew-pew. All right, so getting right into it. Last week, we got some inflation reports that came out, but we also got an update to how the job market has been. So yes, we had the first week of jobs week to give us a report of how the unemployment rate is and job openings and stuff like that. Last week was a lot of revisions to the previous reports from like the previous months. But we did get a really, really big update. So let's start with the inflation side first. Inflation, for the most part, we can't expect it to get any better moving forward. For the most part, the way it's calculated, how numbers fall off, and all that stuff, for the most part, the inflation is gonna do what it's done, but for the most part, there's really not much more we can improve upon that side. So one of the inflation reports showed that inflation did go up a little bit. It was relatively within expectations. And the thing is, when they make these predictions, when they and decide how to react to these reports, they set a they set a forecast of how much it's going to go up by. So, for example, in this consumer price index, they expected it to go up by 0.3%. What actually happened is that the inflation report went up to 0.4%. It went up 0.4%. So for the most part, that didn't really cause a huge market reaction because it was somewhat within expectations. So therefore, the market didn't, as far as stock market and the mortgage market, didn't necessarily react all that much. So if it's all within expectation, even going up, sometimes the market doesn't react. And sometimes if it's better than expected, but inflation overall still went up, that's still a good sign, especially for mortgage rates, for it to come down. But for the most part, overall mortgages aren't right now. My strategy in regards to predicting what's expected to happen on those days is no longer the inflation reports anymore. Pretty much up until probably July, I stopped using inflation as a gauge of when to lock my clients. Now, the thing is, it's all about labor at this point. So the unemployment rate showed a big move, and last week BLS has announced that for the last 12 months, they made up over 900,000 jobs. Like made it up. Like it wasn't real. Like that actually didn't happen. So all the jobs report that came out, like the amount of jobs that were taken up by people and were cause sometimes our unemployment rate going down, those were all made up. It wasn't real. It was over 900,000 jobs that they made up. And that was the biggest issue with the BLS jobs report was because of that. The previous year they made up over 800,000 jobs. So the last 2 years they made up over 1.7 million jobs that didn't actually exist over the last 2 years. So that's one of the reasons why having this new head of the BLS who came in shows a lot of promise, because this guy that took hold just had the same view of what was going on with the labor market. We knew that the labor market was weak, but for some reason the unemployment rate, BLS, who's in charge of that, showed that the unemployment rate was going down, if not was staying steady. So now this guy's new in place, who fired the previous head of BLS, is going to hopefully right the ship and show the actual report of the numbers of what we're actually seeing in reality. So what that means is that moving forward is that the unemployment rate and the jobs week are going to be a pivotal point in deciding where mortgage rates are going to go. So that's the main thing. I mean, for the most part, that the big overstatement of the job growth of 900,000 jobs. And here we have the continuing jobless claims, which means people who continue to file for unemployment and that don't have a job, still remains above 1.9 million people, right? More and more people are still filing for unemployment benefits. Inflation was up within expectations, and the last note is the last 12 months for appreciation nationwide is about 1%. So appreciation is slowing, not so much that it's down, It's just not appreciating as much as we were used to back in 2019 to 2022, which again, and if you guys watched my videos previously, those appreciations that we've seen between those 2019 and 2022, extremely unsustainable, right? You're seeing 10 to 15% appreciation. At least that's what we saw in Washington State. So to see it kind of recorrect to a lower rate of appreciation, keyword lower rate, not depreciation, just a lower rate of appreciation, will allow the economy to kind of catch up to what home prices are doing. Now with mortgage rates coming down, this kind of helps equal, level the playing field a little bit. So to kind of give you a quick scope of how mortgage rates have been trending the last week, we're pretty much flat, which is to me, welcome news. So if you kind of see, what we've been seeing since the start of the year from here, start of the year of January 2000 of this year, we're seeing a pretty nice trend going downwards. And we're even lower than where we were back in March when rates were at that level. So if we kind of go back further, I mean, we're seeing rates eventually start to dip down further and further. Again, the next big marker is the next unemployment rate. All these big drops that you see are, if you notice, have to do with the unemployment rate coming out. So basically the beginning of August, end of July, this is where the jobs report came out. This is the big drop that we saw. Same thing this 2 weeks ago when the unemployment rate came out for September, same reason. In one day, it dropped quite a bit. These other drops, for the most part, I mean, you were seeing, if we're narrowing down July, I mean, we did see a nice drop in because of the unemployment rate coming out. So just further reinforces that, these mortgage rates change every single day. And these are just the average of rates. There's rates that range all over the place, but for the most part, it is trending downwards. For government rates like VA, USDA, FHA, we are seeing rates in like the low sixes, maybe high fives. And then same thing, conventional is a lot lower as well. So when I'm looking at all this stuff, when it comes to clients that are under contract and when to lock, this is what I'm looking at. I'm not locking right away. I'm looking at depending on how these unemployment rates coming out. So I have a whole pipeline that I waited to lock until this September jobs report came out, and saved clients at least 1/4 to 0.5% on their rates, as well as thousands of dollars on their rate buy down as well. So those are things that I want to be looking at as a loan officer in this marketplace, trying to figure out when is the best time to lock. And right now, between the jobs week and the job revisions, which typically comes in the following week, those are the things I'm going to be narrowing down on as far as timing when it comes to locking rates on clients. So otherwise, that's all I got for you guys today. Hopefully you guys gained some valuable info about how to move forward. But otherwise, that's all I got. Duke out.